Welcome to Market Research, and I wanted to do a stock review on Dollar General. Um, Most of the companies right now which are like going up and being hyped are mostly like these growth companies and these AI stocks which are catching investor revenue. And they might have a lot of growth in the future, but there are some great opportunities which are hiding in plain sight, which are not as exciting companies, but could give great returns in the future if researched and invested in properly and at the right price. So, the company I wanted to talk about was Dollar General. So, let's look at it. So, Dollar General has taken a beating this year. So, you look at this stock, this was a $250 stock just at the beginning of this year. And many stocks in the S&P have rallied, or mostly the tech companies, but many of the stocks have gone up this year. This has dropped 50%, which is may indicate a discount or many problems with the business. So let's go on macro trends and see how the business is kind of running. So I wanted to go into the revenues. So let's look at the revenues. So overall, we're looking at this as a long-term investment. And in the past 10 years, we've seen pretty strong revenue, consistent revenue growth, which is very important. So it can compound over time. You saw a pretty big jump here in COVID compared to other times with 20, 27, 24. But now we have more normal growth margins or growth, which is to be expected, and it's not priced at 27% growth. So, and these kind of like more boring normal companies, some of them can be done very well and can be really good for investors. So one I wanted to talk about was actually AutoZone, which is just car parts, car repairs, stuff like that. So this company has had crazy returns overall in the past 5 years. Just very consistent growth in just revenues each year. And what they do, which most companies don't as much, is they keep buying back shares. They buy back an insane amount of shares. You can see how much they're buying back. They're eating up these shares. 7%, 7%. This is crazy amount because you see, let's say 5 years ago, around 2017, 2018, you see a nice decrease from 270, $280 million in shares, or 280 million shares. Now it's around 19 billion shares, or 190 million shares. So that is a very sizable decrease, and is like automatically a 60, 70% gain just based on the share buybacks alone. So this is what Dollar General was doing and created pretty stable growth for a good amount of time. So let's see what the risks are in the business and what everyone's scared about. So there are some margin issues right now. So let's go into the margins. So yeah, their profit margins are on a decline, which isn't good to see right now. So many companies have problems right now of either having too much inventory or too little inventory. You see these companies like Nvidia having too little inventory and trying to sell as many chips as possible, right? Dollar General, the problem with that is they're in the opposite situation, which isn't good. They have a lot of supply which they're trying to get rid of. If you have too much inventory, it's going to lead to price cuts, then worse margins right now, which is a short-term problem. Another headwind affecting margins is interest rates going up, increasing their debt payments, and they have doubled last quarter, which is a bad sign, but they'll probably start growing at a slower rate now, like a considerably slower rate, and come down if the Fed cuts interest when the Fed cuts interest rates. Another problem which is frightening analysts is same store sales. And they've decreased this quarter, which is the first time in years that has happened. This is probably because of a weaker consumer right now. Maybe we might be entering a recession soon. We're seeing a lot of, um, or we're not seeing as much spending this year compared to like 2021 coming out of COVID and many people having money. So overall, what are some of the positives and how is the company going to actually move forward from here? So Dollar General is a pretty resilient business in how their cash flow comes in and goes out. Normally, even in recessions, mostly um, cars, these kind of things, they get hit, they get crushed. Their revenues, mostly luxury, big ticket items, don't get bought during recessions. But like things that Dollar General sells, like food and these other types of necessities and cheap things, normally they don't go down even in recession. It may be like a good maybe 2-3%, which is not that bad compared to some other companies' revenues might drop 30-40%, right? So this could be a good play to diversify if you're thinking maybe there's a recession in the near future. So they've also actually brought back their old CEO, which will be helpful because he actually retired like around here last year, and he was bringing really good growth. But they brought a new CEO. I can't put all the blame on the new CEO because I feel like the market environment has kind of deteriorated too in the short term. So it's not all his fault, but I feel like a more experienced CEO who's run it well will be able to take head of the company in these pretty weird times, I guess, to say the least. So there's also another thing I wanted to show you guys is actually the insider transactions. There's actually been a good amount of insider buying, and there's only one reason anyone from the insiders buy, because they believe the stock price will go up. Many people sell stock for many reasons, like maybe paying off some debt, maybe they got some like payments that they need to do, same thing as debt, but maybe they got a yacht they want to buy, a new car, something like that, right? An expensive car probably, but so looking here, like $1 million buying, they're taking out their own pocket and they're buying the stock. So they probably believe. You see 200,000, 700,000, and people are buying at even higher prices. So they probably thought it's undervalued then. Right now it's around $120. So you're getting a discount compared to most of the insiders who are buying. So which is good. So another thing that is pretty good for the business is they're still expected to open another 1,000 stores, around 1,000 stores next year, and revamp a good amount of stores too, which will probably grow revenue in the future and is always good if they keep, if the power of these kind of companies is they just keep expanding stores and creating revenue growth in that way. So another perspective I wanted to talk about, which I don't think many people are really thinking and digging deep into, is inflation. Inflation is bad for every company, honestly, but I feel like it's less bad for like companies like Dollar General and like companies that own stores, because they have more long-term leases. So most of their debt is way out into the future, maybe 10, 15 years. And most of their interest rates, they might be fixed, but probably that they might be like adjustable too. But inflation overall isn't as bad because the inflation will actually eat into their debt, and that's actually good. If inflation is eating, it's actually a hedge to inflation, because when your debt is becoming lowered in value actually, because of the inflation. So your debt is worth less. So that's better for you. And Dollar General, they're getting all these stores up front to sell at, but they pay later. So that's pretty good, right? And to wrap up this analysis, I would say this company is undervalued at today's price of around, we'll say $120. I would say the fair value for this stock on the low end is probably around $200. And with probably, if there's not any big recession or anything like that, I think margins will come back, company keep growing, and I think it's a good play to keep long term. I don't think Dollar General is going anywhere. So thank you for listening, and I hope you found this valuable. Don't forget to subscribe and like if you want to see more content of this nature.